This is Satya Pradyuman of Cirrus Research. The latest issue of the briefing report is just out. The title, Bond Volatility in December Offers Cautionary Close to Sharp 24 Gains. And that's right. 2024 was a very strong year for equity markets. In fact, the U.S., a dominant market, the S&P 500 was up over 23%. What's interesting about it, though, is that it remains a fairly narrow market. The reference is to Mag 7 dominance, NVIDIA. They still hold very much what we saw in 23. A couple of things to bear in mind, though. What we also saw in 2024, which is interesting, was the performance of the financial sector, which we saw was a very, very constructive year. In fact, the smaller investment banks surged 52% in 2024. So from a sector that was severely lagging the prior few years to a sector that's really put up some of the best performance numbers outside of technology, this suggests that the markets are already broadening. Importantly, with the new administration in place, the belief of regulatory air cover is on its way. These are the elements that support the financial sector. We've had a full year of where we saw credit spreads rally to historical lows. From what we see currently, that sort of setup is still in line, allowing the financials to remain with trend in 2025. Another important item in the briefing report is this idea about earnings expectations and performance. At some point here, valuations will matter. And what we're now starting to see is, given the sharp run, whether you're looking at the large cap market or even small cap stocks, in addition to that, what we're now seeing is that the earnings estimates, those forward numbers are starting to decelerate. So our point here is that this is now really a market that is changing to where it potentially becomes more valuation sensitive. After all, if the earnings acceleration story starts to slow, by definition, investors pay more attention to valuations. A good case in point is NVIDIA. NVIDIA's stock share prices have grown tremendously over the last couple of years. What's important, though, is in the last couple of quarters, we have finally begun to see the NVIDIA's top line growth decelerate. This is important, and again, it tells the same story, which is this idea that downstream spending will likely begin to take on a greater share of market performance, and as a result, another plot point on why the market is broadening. And then finally, as much as the markets have been very good, to be in the large cap growth active box has been really painful for managers. What you're looking at here is this massive gap that's opened in the last year or so, where you're looking at almost 30% performance gap between those strategies in the large growth area that are valuation quality sensitive versus a pure trending strategy. So these are the traits that make the active results really, really tough. If we're right about valuations mattering and downstream spending on AI continuing, these broadening traits will likely support the active management results as we look forward in 25. Take a look at the full report, and as always, happy to take your questions. Thank you.